Well, it looks as though we're live on YouTube and live to the nation. Good morning and welcome here from Cheltenham, Gloucestershire. Still in lockdown, although I don't think we are anymore, but nobody seems to know what's going on. Actually, it's quite clear, actually, if you listen to the news, it's quite clear what's going on, which is great news. Welcome to our mortgage live stream, and today I want to talk about all sorts of aspects around mortgages for you. Got some great little tips and ideas for you. I want to talk about the mortgage market first of all and how it's going to affect mortgage brokers. I then want to have an update for you on the law of intestacy. Then I've got a little bit of work for you on silver borrowers as well. So that's what we've got planned for you. What's been going on in the marketplace? Not a lot really in the last week or so. Not a lot. Interestingly, though, with the request to go back to work if you can from Boris yesterday, I think surveyors and valuers are going to be out there doing their thing. Estate agents are going to be out there doing their thing as well, which is great news for the purchase market. It's still only early May, so you've got May, June, July of the traditional purchase market. So we might see a little bit of movement going on, which would be great for the mortgage market, particularly if you're in the purchase area as well. Anyway, let's get cracking with our topics for you along the way. First topic for you, I want to talk about the marketplace for you, 2021 for brokers. So let's put a little title up there for you on this one. I'm talking here about brokers, so mortgage brokers really, mortgage advisors, call yourself what you like, but I've called you a mortgage broker. And I'm going to take a look at what's going to happen to the marketplace for you in the next year or so, because there's an awful lot of things going on. Listening to some industry heavyweights last week on the media about what's happening to the market, it's good to be able to formulate an opinion and a position as to think what's going to happen so you can plan accordingly. So I've got some thoughts for you for the next year or so. Well, first of all, money. There's plenty of money out there to lend. So let's take a look at a big bag of cash there. It's not like the crunch was back in 2008, where there was no money, where we had a credit crunch. Now we've got plenty of money. You've got the Bank of England term funding, pummeling a ton of money into banks and building societies at virtually no interest rate. So they're pretty much awash with cash to lend. So there's no shortage of money from there. Now the non-bank market is a little bit stalled at the moment. The wholesale market, the wholesale lines of credit, warehouse lines of credit, which specialist lenders use, is a little bit clogged at the moment. Securitization is a little bit stalled. So you've got a couple of types of lender if you think about it. You've got your banks and building societies, who are your typical retail lender. And then you've got your specialist lenders, your foundations, your precises, those sort of people. Now they get their money from different places. As I mentioned to you, the banks and building societies have got this Bank of England money at the moment, so they've got plenty of it. Whereas the specialist lenders use warehouse lines of credit. It's a little bit stalled at the moment, but it's beginning to loosen up somewhat, which is why they've been taking some of their products off the market place in the last few weeks or so. The securitization market is a little bit stalled as well. Of course, that's a worldwide thing, so that will start to release itself. So there's plenty of money to lend, and that's the first thing to bear in mind. So what about the marketplace then? Well, first of all, the purchase market. So if you're a mortgage broker and you rely on the purchase market, this is the traditional, somebody rocks up, makes an offer on the property, somebody else sells it, there's a mortgage to buy the house, a mortgage to be redeemed, a new mortgage on their house, etc. That's the purchase market. So what's happening in the next few years then? So we've got 2020, here we are, and here you got 2021. That's sort of an idea for you. What's going to happen? Well, the market was pretty buoyant at the beginning of the year. Of course, that's gone down now with this close down, this lockdown. I think it'll trickle, it'll come back up again, I'm quite sure, but it's not going to come to anything really. And arguably, it will probably go up again in 2021. That's the purchase market. But nobody really knows what's going to go on. But more than likely, it's pretty stalled now. Although, everyone's back to business now. Estate agents are back. You've got valuers back, surveying again as well. It all depends upon the purchaser, the first-time buyer, the second-time buyer having confidence in the marketplace. And we're into recession here now, where people are losing jobs possibly, or furloughings, not going back to full-time jobs. So, go take a look at confidence for people to make this big move suddenly. But you could find that it could move again. So probably 2021 onwards, the purchase market's going to peak up again. But the point is, though, there's more you can do as a mortgage broker. So where's your focus? Where do you need to focus your attention on? Well, there's 5 or 6 things you can do. First of all, then, again, keep my pictures going for you. The first thing you need to do, we'll squeeze this over here for you, is you need to work your book. If you're a mortgage broker, you need to work your book. Now, your book is not a book, as we call it. It's your client bank. It's the clients that you've dealt with in the past, that you've either handled before, or you've dealt with before, or you've talked to before. It could be you're part of a bigger firm where they've got a big mortgage book or book of clients from the past. It could be that you're connected to an IFA firm where they've got a big book as well. So you've got to work your book. You've got to harvest your book. Gardening is the best metaphor, isn't it? Now, I'm not a big gardener. My partner, she loves the garden. I don't particularly enjoy gardening, apart from cut the grass, enjoying the sunshine. But I believe if you're going to be a gardener, you've got to tend the garden, you've got to water the garden, you've got to weed the garden, you've got to put some compost on, you've got to turn it over, you've got to clip things, you've got to prune things. It's a constant working at the garden to make it grow, make it bloom. Now, in good times, of course, where there's plenty of rain and plenty of sun, you don't need to do too much work to a garden. It kind of makes itself. And a lot of brokers have done that the last few years. A lot of IFAs have done that. They've kind of got into easy street, if you like. A lot of brokers get phone ringing or email pings. They get lots of new business. They're not had to work their bank, because working your garden takes time, and working your mortgage book is exactly the same thing. It takes time. You've got to contact people. You've got to talk to people. You've got to contact. You've got to connect with them. You've got to fact find them. You've got to see what other needs they have. You've got to protect them. You've got to advise them. You've got to talk to them. It takes time. It's hard work. A lot of kickback as well. So you've got to work your book, number one. When you work your book, you've got to look at other areas of need that these people might have beyond just the mortgage itself. And that's when you look at protection. You look at critical illness, you look at income protection. People are starting to think about that now. So do a fact find around that. Look at GI, general insurance. Look at wills, look at powers of attorney. If you don't sell them, refer them on to somebody that can deal with those things. So though that's quite time consuming, I mean, medical's taken an age at the moment with the NHS. They're doing they're doing a great job, but of course you can't write to a doctor for a medical report and expect the doctor to respond quickly anymore. They're not. So to underwrite protection, to do a protection policy for clients, a lot of effort, a lot of work. And some brokers won't be wanting to do that. But if you want some business, you've got to be able to do that as well. Number 3 is to think about the mortgages that people have already got. Do they need to change them? Do they need to transfer? So you've got to look at your transfer business. Obviously, you've got to transfer products that come to the end of a fixed rate. You might have somebody on interest only, for example, that might want to consider switching it to another type of mortgage. You've got different variable rates, maybe into a fixed rate. You've got somebody who's on a Bank of England base rate, might want to stay there, they might want to move. You've got to look at transferring mortgages. So contact people, see what mortgage they've got, see where they're coming to an end of a scheme, end of a product, for example, because the banks and building societies will contact people at the end of their system, end of their fixed rate period, because they will. And I believe that, that there's not an awful lot still that brokers are doing in this area. They're doing a fair bit, but it's still a business area the banks and building societies are gobbling up, the transferring the fixed to a new fixed deal. So look at ways in which you can do that as well. So that's the third thing you can do. The fourth thing you can do is remortgages, of course. The buy-to-let market is open for remortgages. Normal remortgages, people might just be on a scheme where they might want to just change lender. There's some really good rates of interest out there at the moment. They're really low. I mean, the Bank of England term money they're giving to the banks means that they can lend at a very low rate of interest now, still make a little bit of a margin profit. So look at your remortgages. That's a key one as well. The fifth thing to think about as a mortgage broker going into 2021 is your cash flow. You've got to think about your cash. How much cash have you got in the bank to pay your bills, to pay your drawings, pay your profits, keep you going? If your traditional stream of income is not coming through, you may have some money there, you may not. I'm not judging if you haven't, but if you haven't, think about the government lending, think about the government schemes furloughing the staff. Of course, it's been going on for a while now. Think about the civils, but what about the bounce back loan? Yeah, get yourself a bounce back loan. They're pretty darn good, the bounce back loan. It's well, it's interest free, it's payment free for a whole year. So if you took one out now, what are we not far off middle of 2020, you don't have to make any payments until the middle of 2021. So you've got this whole 12 months of no payment. So you can bring some money into your business, bulk up your business cash flow, keep yourself afloat nicely, stop the stress coming in, and maybe if you start making some money, you can pay the loan back a year later with no fees. There's no penalty fees in repaying this bounce back loan, and when you do, it's only 2.5%. You might think it's the thing to do. Even if you don't need it now, it's probably good to apply for one, get it sorted, because they may not be available in the autumn. You don't know how long they'll be available for, do you? So get the money into the bank account now. Get your cash flow in a good position. It stops the stress. It stops the worry. It makes you feel good. It gives you a relaxed sense of ability that you'll be able to go and work your book and get some business in as much as you can. And maybe next year keep the loan going or pay it off when things bounce back nicely. It's called a bounce back loan for a reason. So that's some ideas for you as a broker. The other thing, the final thing to think about is there is scope in the market for brokers. Now, back in the pre-crunch days, 2006, 2007, at one point you had 30,000 mortgage brokers in the mortgage market doing business, about 2007, 2008, 30,000, 30. Now, with the credit crunch, of course, that killed the market, and it went down to 10,000 mortgage advisors within a period of less than a year. So from 30,000 down to 10,000. And that 10,000 number trickled alongwards for a long, long time. Many of those were banks and building societies people. Now that meant that there was nothing going on in the mortgage market. It has increased up to about 18,000 now. So at the peak you had 30, now we've got about 18,000, 1/8 mortgage advisors. There's still scope to go back up to where we were 15 years ago. So there is a market out there for us. We need to be able to work hard to make it happen for us, but definitely positive signs for us, but not probably until 2021 onwards. We've got this year to get through, this recession that's kicking in now, depending on what goes on in the next few months. But it's positive. You've got to work hard though. It's time to get those muscles out and start working harder. That's been useful. Bye. Did you enjoy that, did you? Or not enjoy it? Depends where you are really in the marketplace and what your world is looking like really when it comes to it. So let's get that rubbed out now. We'll move on to another topic for you on our mortgage live stream, our CMAP live stream. Now, if you've got some time looking to get some of your exams out of the way, CMAP, of course, is a key one. Equity release exam is another key one. You need to look at those areas for you. Maybe even segue into becoming an IFA. You might want to look at those exams. You've got some spare time on your hands. Why not do it right now? Let's talk about a new topic. We're going to talk about the law of intestacy now for you. The law of intestacy, often called the succession laws, the law of intestacy. And we're talking here about dying, so that's not beat about the bush. We're talking about dying, and you're leaving your estate. That's what we're talking about here. And we'll talk about the rules that changed a couple of months ago. Some of the numbers changed. We'll update you on those for you. We're talking here about dying, what they call intestate, without a will. So when we talk about dying intestate, lots of people take out a will, last will and testament, which of course determines where your money goes on your death, what amount, who to, etc. And there's not a lot of cost involved in taking out a will. But people that don't take out a will and die are known to die intestate. So there's your intestate. Now this means that there's no written document determining where your money goes. So the government takes over, the law takes over. And you get an administrator who gets involved in the process, you've got to have somebody who's interested in your estate if you've left some money, some personal representative, somebody who needs to go to the probate office and apply for letters of administration. They're an administrator, and they then administrate the estate and dish it out accordingly. Now, how do they dish it out then? Well, that is down to the law of intestacy. So let's talk about that. Let's get some pictures going here, first of all. But first of all, the big question to ask is, are you married or in a civil partnership? So that's the first question that you ask yourself. So are you married or in a civil partnership, yes or no? So you've got two sequences going on there. If the answer is yes, you go down here. If the answer is no, you go down here. So let's go down the no bit first, because that's quite an easy one, really, I suppose. So you haven't got a spouse. So first of all, do you have children? If you have children, there you go, do you have children, which you might have had, of course, from a previous marriage? If yes, then the kiddies get all the money. which makes absolute sense, doesn't it? It's shared equally amongst them. If you don't have children, the next thing to ask yourself is, do you have your parents still alive? If you do have your parents still alive, then again, it's shared equally amongst parents. If you don't have your parents alive, then it goes to your siblings, your bros and your sisters, so your brothers and your sisters. Again, it's shared equally amongst them as well, if you have those. If you don't have brothers and sisters, it then goes to your grandparents. So let's squeeze it down here, might have a little bit of space down here. Your grandparents. If you don't have grandparents, then it goes to your aunts and your uncles. So basically, it's all your relatives, really, isn't it? There you go, it's just the order there for you. But of course, if you don't have any aunts and uncles, then it goes to the crown. I remember back in the day when I worked in the building society business, back in the 80s, and it was January time, where of course we had lots of deaths then, of course, flu and illnesses and stuff like that. And I got this letter through from a solicitor saying, please would you cash in this deposit account that's owned by this chap who's died, and please make it out to Her Majesty's HMRC, Revenue and Customs, because this poor chap had died without anybody. And it kind of gave me a bit of a shiver down the spine, really. This poor chap had nobody in his life at all. He had a load of money in his account, which then had to be cashed in and sent over to the Treasury. Obviously, if you live in Cornwall, it goes to the Duchy of Cornwall. Well, Prince Charles gets a load of money then, doesn't he? But effectively, it ends up in the Treasury. It's quite sad in a way. I just wonder why the bloke didn't spend all his money, why he hoarded money until he died. But there we are. So that's the right-hand side. Now, over here on the left-hand side, it's a little bit more complicated. That's where the changes occur. First of all, are you married? Yes, you are married. Okay, now, is your estate worth more than £270,000? Is the first question to ask. Is it worth more than £270,000? It's worth remembering that figure. Is the first question to ask yourself. If it is worth more than £270,000, then your spouse, go down here, yes. If it's not worth more than £270,000, then it goes all to your spouse. So your spouse gets it all. There you go. Ta-da! So if you've got a couple £100,000 in your estate and you die, then he or she gets the lot. That's fine. If you do, though, have more, then it starts to get split, and that's where the issues start to occur. But first of all, do you have children? Is the question. Similar to that one over there, of course. If you do have children, yes. There you go. Then it gets split. And what happens here is that the spouse receives 270. There you go. The spouse gets 270,000. So it's the same figure to remember as well. And then the children get the rest, but it's split in half. Half goes to the children, and the other half goes to the spouse. And the children, of course, get a life interest in that as well. So the spouse gets £270,000, and is also entitled to the other half of the estate outright, and then the other half goes to the children. So you have to work out the numbers there as well to see how it works out. So if you've got, for example, like £1 million, the spouse gets 270, and is also entitled to half of the remainder, but the other half then goes to the children. So it gets split, and that's the issue behind the problem there. It might be a house, for example, that you have, or property that needs selling and dividing accordingly. If you don't have children, then it goes down the button there. Then it goes to parents in a similar manner there. If you do have parents, then the spouse receives the whole estate. Parents don't receive anything. If you don't have the parents, it goes down still, and it goes to brothers and sisters. Just bros and sisters. It starts to get divided accordingly. You need to check the details for that one. But the key one here is that the spouse will get below 270. If it's above 270 and you've got kids, it starts to get mixed around, starts to get separated, starts to get divided, and that's where it becomes quite unfair, you could argue, although it's still going to your family effectively. And it's the 270 that you're often asked about as well, and that's the key one here. Less than 270 goes to the spouse, more than 270, spouse gets 270, and then the rest of it is then halved. half goes to the spouse outright, half goes to the kids, and they get the money when they all die. So that's the rules of intestacy. Is it fair? Well, you can argue it's fairly fair. It's not unfair. It's just a bit of a muck, really, isn't it? So the key rule there is to make sure that you take out a will, or you do a will, because that in itself determines where the money goes, in what order, and therefore people end up with the right amounts of money rather than leaving it to the estate or to the government state to divide it according to the law of intestacy. Hope that's been useful. Bye. There we go. So nice little angle there for you on intestacy. Hope you found that interesting and useful too. Let's get that rubbed out. And we're going to go on to our last topic, really, which is diving into the silver marketplace. Silver surfers, as they call themselves. Let's get into that area, shall we, for you. Just a little bit of an update for you. I'm calling this debt counselling. There we are. Debt counselling. Oops. Debt counselling. Spelling right there. For silver borrowers. Now, the silver borrowers phrase is taken from the later life marketplace. We're talking about people with silver hair, like me, who are looking to borrow, which is about debt counselling. Now, the issue here is that long gone are the days when people who come up to retirement have got rid of all of their debts and they're completely debt free. So when they enter retirement, they've got lots of disposable income and no debts. Now, that's not right anymore because a lot of people are entering retirement and they've still got lots and lots of unsecured debts. And you look at the numbers, you'd be quite surprised what's going on. And what's happening there is that people then decide to release equity on their property to pay off unsecured debts. So you've got the situation where you've got the elderly homeowner who's retiring, or whatever it is, age, but they've got some debts, some unsecured debts. So they've got some credit cards, some loans, store cards, or whatever. So what they decide to do is they decide to release equity on their property to raise money to pay off the debts. So effectively what they're doing is they're taking out a mortgage, if it's a lifetime mortgage, on their property to pay off unsecured debts, which actually is a damn good reason for releasing equity on property. It's quite okay to do that, and people are quite aware of the issues here because often the payments that they pay interest only are a lot more affordable, but obviously they're not making any payments. It releases up lots of unsecured income for them, or I should say disposable income, which they can then use to buy what they like. But the big issue here, though, is that they need to be aware that they're transferring an unsecured debt to a secured debt. It's obviously something people need to be aware of, because suddenly you've got a mortgage which is secured against the property. So that's a big issue. Obviously, the monthly payments might be going down to nil or very much lower, but they've gone from unsecured to secured. Now, you might, though, think about, rather than releasing equity to pay it all off, you might consider them requiring some kind of debt counselling. So that's really where the phrase comes, debt counselling. Remember, with equity release, you really got to look at other avenues before you explore equity release. Equity is kind of like the last resort in a funny kind of way. You've got to look at other ways in which you can help the customer. And if it is quite clear they just need counselling in their unsecured debts, then that's what you need to recommend. Now, you're not able to do this because you're not authorised. You won't be authorised unless you've got special permissions. But of course, debt counselling itself is a regulated activity now. So what your job is then is to refer them on to a debt counselling firm who can actually deal with that issue. Step Change is one of the best firms that I know of. Step Change is a charity recommended by lots of banks and societies for people that are in debt problems. And they're actually a member of the Equity Release Council as well. They joined it last year. So they're involved in this marketplace. They understand what's going on. They're a non-for-profit organisation who spend people, and they will recommend what these people need to do. So really the moral of the story is if you think that the customer needs help with their debt management rather than just paying it all off with another loan, because they'll probably get into the same problem again. That's what happens, isn't it? People get into the same issues again, they start borrowing again unsecured. Get them to refer them to a debt counselling association that can help them with that debt. And once they've got that under control, then maybe you might want to consider an equity release arrangement. So that's a big issue there. Vulnerable customers. It comes into mind, vulnerable customer. This is a vulnerable customer, somebody that is under pressure with debt is certainly a vulnerable customer. I've been in the past where I've had debt and you get vulnerable. In other words, you get susceptible to deals. The post comes in, oh, that's a good deal. I'll get that credit card to pay off that credit card because that's a better credit card than that credit. You become vulnerable, susceptible to marketing, advertising more than normally. So that's vulnerable. If you think about vulnerability, a lot of people, of course, are going into vulnerability with this recession that's coming in post-COVID. People become more and more vulnerable. So as a mortgage advisor, financial advisor, you've got to have policies to deal with people who you categorize as vulnerable. And you may not just want to go and sell them a product because it's a quick fix. Sometimes you might need to look at ways of helping them. And debt counselling certainly want to think about. Just because they're old doesn't mean they don't need debt counselling. They probably do in certain circumstances. Hope that's been useful. Bye. Ha, there you go. So interesting. I hope so. Mortgage live stream done for another week, really. We're going to be back next week, talk about some more issues for you. Hope you're well. Hope you're enjoying the new freedom that Boris has given you. You can go to the parks now. You can go out for leisure and exercise much as you like. Although if you're in Scotland and Wales and all that, it's different, isn't it? But let's hope you don't live near the border. So don't go off for your leisure over to the Welsh border because you can get stopped by the coppers. Because you stay in England, you're okay. So it's all a bit confusing, but there we go. We won't worry about that, will we? We'll see you all next week.